Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. It is early in 2021, and already we've seen the rise of the individual investor and Wall Street waking up to the power that individual investors can have. I don't know if I'm overstating that, Jamie. What do you think?
Well, it's certainly something we've been thinking about for a while, but we likely have hit some kind of tipping point in 2021.
Yeah, indeed. And so this is Jamie Wise. He's CEO of Periscope Capital and founder of Buzz Indexes. And we're going to be talking about just that. I think what we saw and what we have seen so far in 2021 with the rise of the individual investor, as it's been described, has actually been something that has been kind of, I guess, say in the works for a while. Wouldn't you say, Jamie? I mean, you've obviously been kind of focused on gleaming information from the individual investor. Do you think reading the minds of millions is an adequate topic for our discussion today?
I'm not quite sure we're mind readers, but I think what we're doing is finding insights from the investment decisions and the process by which they're made by millions of people and how that's changed over time. And really it's the growth of online platforms that have allowed individuals to collaborate, to share ideas, to share their research, and then to get feedback. And that's sort of been a virtuous cycle. And of course, it's all things internet that have allowed individuals to accomplish those things in terms of their access to information, their access to resources to make better investment decisions for themselves. I think what we're finding and learning today, it's been a theme for the last number of years, is those individuals really do put in the work and they do come up with thoughtful ideas, interesting investment concepts. And then, of course, through these social platforms can really share those with others, and that community continues to grow.
Can you perhaps give us a little background about yourself and Periscope Capital? What is your main focus and what is Periscope Capital, and talk a little bit about Buzz Indexes?
Sure. So Periscope Capital is a hedge fund in a traditional sense. My background and my partners at Periscope come from an equity derivatives lens. I've always been fascinated with markets, thinking of them as this puzzle piece of information to put together, and how do you make good ideas around that. And together with, I guess, a bit of a love of math and non-linearity, that led me down to an equity derivatives path. We launched Periscope, in 2009. So we've been around for a while, thinking about different arbitrage-like strategies within our firm and our funds. And Buzz Indexes is really the outcome of a research project that we started at Periscope 7-ish years ago. So it's been a while. And the way that it all came to be was, back then I had seen some academic research and some early notes around the growing prevalence of these online communities and individual investors, looking for a forum to collaborate and share ideas. Sentiment has always been something that's fascinated me personally. And so my thinking at the time was, well, if more and more people are going to be going online and sharing their investment ideas and empowering themselves to make better investment decisions, there certainly must be some value in that information. And wouldn't it be great to understand the collective conversation? And maybe we could later rest this thought that many of us, or many people, have had in the financial community for generations, with this idea that sentiment might be contrarian, or that individual investors might be a contrarian signal in and of themselves. And here, all of a sudden, we were seeing lots of data, or at least at the time, what we thought was lots of data that's grown considerably, where we could start to measure things and use data to really understand that conversation and understand the measure of sentiment, not by way of proxy or gut feel, but really supported by all of these posts that we were observing. And here we might be able to lay rest to that conversation and really understand what sentiment is. And that began the research project that ultimately turned into Buzz.
What are some of the other things that you perhaps considered as you were starting the index or the research around social sentiment? I mean, I've heard things about hedge funds or other institutional investors sourcing a lot of alternative data sets. Did you consider other avenues that perhaps other hedge funds might be using, other topics?
Yeah, the alternative data sets, that became a big industry for hedge fund service providers. Could involve things like transactional data, so anonymized credit card data, or it could have included the geo tracking or satellite imagery, any kind of non-traditional financial metric that might allow an investor or an advisor to get a sense of demand for a certain company's products and help them in their traditional research process. I think more and more today, the social or the sentiment aspect of alternative data is more widely recognized. I think that was, of all the alternative data sets, one that took a while for adoption to really take hold. But now, yes, of course, many different hedge funds are looking to that sentiment data or trying to source it in one way or another to try and give them insights. I'd say one of the things we found early on was, having all of this data and labeling it correctly is one part of the challenge, but then aggregating it and making use of it in an investment strategy is a very different challenge. Much in the same way that, we all have access to traditional financial data, whether it be stock price history data or company filings, earnings reports. All of that raw data exists for investment managers and individuals to try and make sense of and make better decisions. Here we have a new data set. We'll call it millions of labeled sentiment posts around what people are expressing, how people are expressing their views on stocks. But then what do you do with that? That's a really big challenge. And I think depending on the type of investment firm you are, you may have a different lens from which to view that data set. You could be a high frequency trading firm that is trying to find very short-term signals. You could be longer-term investors trying to find a different type of signal or a different type of information from within that raw data. And so that I think is where most asset managers are living today with their use of alternative data sets, is how do they incorporate them? Because just having the data doesn't necessarily give you an answer.
How difficult or how complex was the process of building the indices or, supporting that research?
Yeah, the model construction, we found early on was going to be a challenge. We had lots of programming capability in-house at Periscope, but not specific to natural language processing, not specific to, the different machine learning techniques that were being applied to the natural language processing challenge. Where we were fortunate, and we happen to be based in Toronto, is we're very close, just down the street from the University of Toronto, where Jeff Hinton, to those of you, familiar with artificial intelligence or machine learning, Jeff Hinton is really regarded as the godfather of conceiving some of the concept of the modeling.
Your own background, did you have much in the way of computer science, or what kind of track did you come up with in your career?
No, my background is equity derivatives, business school, and the like. So I would say I have a fine understanding of the concepts, but certainly not the technical skills to deploy it. My partner and co-founder of Periscope likes to view himself as the oldest computer science in the world, having a computer science degree from the University of Waterloo, and I won't embarrass him by telling you the year in which he achieved that. But really today, like everything else, it's young people that are really driving the development, right? And so, the folks that we were able to collaborate with at the university, certainly they're guided by their professors, but the energy and enthusiasm they have for the modeling process and understanding these two new techniques really drove the model construction. And one thing that we can talk about is just how important we viewed it as necessary to build those models ourselves. And maybe a quick example will shed some light on that. When you think of natural language processing models, they're really just models trained to accomplish something very specific. So if you think of language translation, you can train a model based on millions of examples of, English and Spanish, for example, and it can start to understand how to translate that based on all of the examples you've given it. But of course, that same model can only do that one very specific task. It can't make you toast in the morning, and it can't answer a math problem. It's just very, very good at that one specific task. When we started looking at the sentiment analysis, what we found was a lot of these social media aggregator or analytics firms that were providing insights to consumer product companies, they may have trained those natural language processing models on language that was around those people's conversations around those products. And people talk about products and restaurants and experiences very, very differently than they talk about stocks. And so for us to really have confidence that the models that were being turned to the conversation about stocks were trained appropriately, we viewed it as best that we train those models ourselves and had confidence that they were being trained to listen to the very specific task of how people talk about stocks. The language is very different. Some of the phrases, things that sound negative could be positive. All of things that us as finance professionals could read and very clearly understand, just based on our own domain expertise around being around markets, whether an individual was positive or negative. We had to sort of impart that experience and knowledge to the models to be able to do the same thing that we were basically doing. Having the computer science and the data scientists work in-house with us, because a lot of these people don't necessarily have the same finance domain expertise, right? And they don't understand intuitively how people are talking about stocks. We could help guide them in the model construction and the model training so that they didn't go down any rabbit holes and make that process more efficient. So that to us is very important. And it's a never-ending process because the language that people use around stocks is ever changing. Now the use of emojis is very prevalent in the conversation. So it's a constant refresh of making sure the models are trained with sort of the latest trading sets and the way that we can augment that training. And that gives us some more confidence that the results of the model are indeed accurate representations of people's sentiments.
So the model can read emojis as well?
Yeah, emojis can be sort of broken down into characters. That's really behind the scenes of most emojis. And so it's those characters that the model can understand, and then understand how they're being used within a certain context. You can imagine stock conversations. There's lots of emojis that might be rocket ships or bears. And of course, rocket ships and bears don't necessarily come up in our conversations or in consumer product conversations. That's a good example there of a model understanding that when it sees an emoji in the context of a stock conversation, it could have a very different meaning than that same emoji in the context of a regular conversation.
So you mentioned sentiment, and what we have been talking about is social sentiment, but there is another idea of sentiment in the investing landscape. Can you talk about the differences between just market sentiment and what we're talking about here with social sentiment?
I think, from the first days that stocks were ever traded down in the corner of Wall Street, people recognized that sentiment had an impact on security valuation, on stock prices. Like I mentioned earlier, the problem has really been for all these generations, how do you measure that sentiment? Typically, the approach had been through polling, right, or surveys. And it's very difficult to survey or poll people across, hundreds or thousands of individual stocks. And so they would generally be market related. People's forward outlooks or people's view of the economy. And then by extension, people would try to extract sentiment from those types of polls or surveys. And there's lots of academic research around potential flaws in that approach. And so we've had these surveys, but naturally none of them have been fully predictive in terms of stock price or market price, the broader market price. Otherwise, it would be very easy to just follow the University of Michigan survey that comes out every month and do a trading strategy around that. So there's obviously some faults in that approach. The next measures that people used to look at would be things like market-related indicators. And it could be, levels of realized or implied volatilities. It could be put-call ratios. It could be flows of different types of investors, institutional flows versus individual flows. And they would try to extrapolate a measure of sentiment around that. And that would, again, be something more broad-based, more market-related. And then, of course, we have the so-called experts, the people that get on CNBC with a big microphone and come up and claim to have a view of sentiment. And it could be market-related or stock-specific. But again, no real data behind the conversation. It could be because the stock price has rallied very quickly that a commentator might say sentiment is too high. And more often than not, the sort of tone of the conversation would be that sentiment is this contrarian thing, that high sentiment should be faded, that low sentiment should be bought. But again, of course, no data behind that. So how do you know when you are at a high sentiment level? How do you know if that sentiment is going to persist or not? Or are you at the peak and you're now prone for a reversal? We've all understood and we all intuitively know that sentiment is this thing that drives markets broadly, but had this measurement problem. And I think the way we talk about social sentiment today, it's really individual sentiment, but it's at the security level. So these conversations and these platforms where these individuals are going online to collaborate and communicate their views, they're not, generally speaking, talking about the broader markets. For the most part, they're stock stories, right? And that's what people always resonate to is the prospects for an individual stock or a theme that might be driving a collection of stocks. And so you really do have conversation that is stock specific or industry specific that you can really lean into and drive insights from, because as we've seen last year would be the perfect example of this. The market went through a tumultuous year with everything in COVID. Regardless of the fact that the market ended up or down, there was a lot of dispersion in the returns. There were clear winners and losers. And so, just thinking about it from a market perspective, if that is your lens to view sentiment, is very difficult, because within the market, there's a lot more complexities, and there were a lot of very big winners last year and a lot of companies that suffered. And so having that individual security lens into sentiment really, I think, is quite important.
So perhaps you could talk a little bit about your benchmark index, how it's constructed, and perhaps how it's evolved since you first created it.
Yeah, Buzz is really a measure of broad investor sentiment across large cap US equities. The first thing that we really did when we understood that our models were delivering high accuracy rates around sentiment is, let's present and create this index where it can be a representation of aggregate investor sentiment. So every voice is created equal. And what we're interested in is focusing on large cap US equities. We did that for a couple of reasons. Primarily, it would allow for the index to be investable. And it would also, in those early days, this was launched back in December of 2015, we thought that it was going to be important that people could understand and recognize the stocks that were being chosen for the index. So these are large cap US equities like you would find in a typical large cap strategy. But the way that they were being selected into the index was based on their sentiment that we were observing from these millions of data posts of people talking about them online.
And so the index is the Buzz Next Gen AI US Sentiment Leaders Index.
Yes, it's a mouthful, but we'll call it the Buzz Index. But the Buzz Index, so every month it rebalances and holds the 75 large cap US equities that exhibit the highest degree of aggregate investor sentiment as ranked and scored by the models. It is rebalanced once a month, and that's consistent with the way we're sort of measuring sentiment, right? So this isn't a high frequency, high turnover strategy. It's really meant to identify almost like the momentum of sentiment or a moving average of sentiment, where to the extent that over some period of time there's been this aggregate positive sentiment, we think that's the representation of the aggregate individual's views towards that stock and its potential performance.
Yeah, so are you looking at a certain number of messages before you consider that for inclusion, and over a certain time period before you consider that?
Yeah, so we have what's called an eligible universe of stocks that could be a part of the Buzz 75. And there's really two key constraints to become eligible. The first is a very simple test. Does this stock have a market cap of 5 billion or higher? The second is a little bit more complex, but essentially what we're doing is we want to be able to observe that this community of individuals has some consistency and breadth to the conversation around this stock before it can be eligible. And what I mean by that is, you can think about it as about a year's worth of conversation. So people are talking about whatever stock it may be for at least a year in this consistent and broad manner, meaning no individual news story, no earnings report, no corporate action has driven a short-term spike in conversation across online communities, and then no one talks about it ever again. Our view is generally, if we can measure and see that there is this consistent behavior and diversity and breadth to the conversation, then when we measure its sentiment, it's much more probable that it is actually reflective of the broader investment community than just some blip because of a news item or some short-term event that's happening in the market. So to the extent that a large cap US equity would meet that threshold, and we review that threshold each quarter, it would then become potentially eligible to enter the Buzz Index. And if you think of how many large cap US equities exist that are greater than 5 billion market cap, say it's some number north of 1,000, between 1,000 and 1,500, depending on the day in the market. Typically, we're seeing now, a third of those would meet the eligibility requirement. So, some number between 250 and 400 stocks that meet this test of breadth and diversity of conversation, that have a market cap of 5 billion, that we can rank for their sentiment each month and select the top 75 to be positions in the Buzz Index.
Let's talk about some of the stock picks. What are some of the top stock contributors that you have seen, say, over just in 2020?
Yeah, last year, 2020, we saw a meaningful uptick in the amount of conversation, which meant more names became eligible to enter the Buzz Index. And as that conversation grows, we really saw the outperformance of the index relative to the S&P 500, by way of example, really start to extend. When I look through the top contributors to performance in 2020, there are names at the top of the list, Tesla, AMD, and NVIDIA. I think that's been that chip maker theme has been really prevalent throughout Buzz for a number of years now. But then we also saw some really, what some would think would be contrarian names contributing to performance. And here I'm looking at a name like Carnival or even a name like Boeing, where it's sort of well documented how those businesses could be very troubled given what happened with the pandemic. But what I think the individual or the collective individual community really showed us is at some point when those shares fell, they fell from their perspective too far and represented value plays, and really did a nice job of, no individual maybe could do this on their own, but collectively, when enough people turned bullish on Carnival at or near the bottom, that really was the bottom, right? That marked, that was a clear signal, at least to us, that something's happening here around the conversation from these stocks, that maybe they are these value stocks. And that is always the most interesting part of the Buzz Index to me, more so than the approach. It's the dynamic nature of it. And it's the ability for, on aggregate, individuals to give you insight into potential themes or continuations of themes or turning points in stocks. And so it's not just this collection of high-flying supercharged electric vehicle companies that are the flavor of the day. People are positive about stocks for all sorts of reasons, right? Because they could be growth names that they expect to continue to grow. People are positive about stocks because they're value, because they provide good dividend yields. For all the reasons that someone might be positive about a stock, that's reflected in these online communities that have those diverse conversations. And the Buzz really does pick up on that. And then when we look even into 2021, that trend has continued in terms of its outperformance. I think Buzz is 16 or 17% of the S&P, ahead of the S&P so far in 2021. But it's a whole host of different names that are driving performance this year than what drove performance in 2020. And that again speaks to, the index's ability to be dynamic based on how the aggregate community is being dynamic. And just that last month's rebalance, we had 3 brand new names go into the index that had never been there before: Virgin Galactic, DraftKings, and Nikola. And lo and behold, Virgin Galactic is up 70% just in a couple of weeks since it was included in the index, really helping this year's performance along. I do think that, when we think about the Buzz Index, it really is about the stocks underneath it, and how dynamic that security selection can be. And when I look at the index today and I see, yes, it's got DraftKings and Virgin Galactic in it, but it also still holds Carnival and GE. I might challenge you to find me any other large cap equity manager in the world that has as interesting a mix of securities in their portfolio, where most, I think, traditional asset managers have a very specific style associated with them. And so you can get a value manager or a growth manager, and in certain market environments, either or will outperform, but then they're still sort of locked into that style where you get something, again, that's much, much more dynamic when Buzz and can be reactive and reflective of market environments and hopefully correctly forecast coming market environments.
Do you have thoughts about how advisors can implement a sentiment factor into a portfolio? What bucket does it go in?
Yeah, well, I mean, it's large cap equity exposure. So I think, to the extent that you're a portfolio manager and advisor and you've identified large cap US equity exposure as something that you want in your portfolio, now you have decisions to make. Do I achieve that by way of benchmarking based on market cap and own the S&P 500? Or do I do something different? Do I think about it in terms of factor exposure? And how can I achieve my equity exposure and what's most efficient? And so now I believe that what Buzz can offer those types of advisors and portfolio managers is a new approach to large cap equity selection. And I think, certainly now more than ever, we all recognize that what individuals are saying about stocks matters more than ever. That the individual investor community is a lot more intelligent than historically they have been given credit for. And here's a way of capturing all of that and identifying their high conviction security list relative to other approaches that might be more traditionally factor based or just market cap based.
So we're capturing collective conviction, if you will.
I believe so. Yes, absolutely. It's their buy list essentially, right? And we're able to capture it, unlike 13F holdings, where a lot of people pay attention to those and they're very lagged in their reporting. Here we can capture conviction buy lists from millions of people in real time. And that's an exciting use of technology.
There might be some perceptions about using sentiment like this. Maybe you can talk a little bit about the process, a little bit more about the process that your model employs. Like, could bots or bad actors, just increase the number of messages on a platform and therefore impact the stock price and perhaps its inclusion in the index?
Yeah, the bot question is a great one. We get asked it a lot, and it's a very fair question. An easy or a good way to think about a potential bot's influence in this online conversation is, if you think there's a bot out there that wants to influence a stock price based on a posting behavior, think back to the pump and dump schemes of the 80s and 90s where we had the call centers, and what kinds of stocks were they typically targeting, right? It's much, much lower market cap stocks, thinly traded stocks that they potentially can move the price on based on their bad behavior. And I think in the online world today, it's very much just an online representation of that same type of behavior. So it's very difficult for a bot to have an influence over the large aggregate individual community if it's something like Disney or Microsoft or even Tesla. First of all, the platforms where these individuals are gathering, using StockTwits as an example, maybe, obviously they're highly incentivized to keep bots off of their platform. Second, whether it's StockTwits themselves or even us here at Buzz, we know the conversation that happens every day. So, if you wake up one day and somehow the first firewall fails and there's 10 million posts saying buy Disney, it would be fairly easy to flag that anomalous behavior and identify and know that that's not real human engagement. What's been most interesting is, since this index has been live, I can't even point you to a single example where that's happened. Certainly not in the securities that we're following that are eligible for the index, because they are typically so large, they would be difficult to influence in the public markets. The bad actors just don't target them. And we do have a bunch of different bot or spam screening tools built into our algorithms. And we can identify that the bots and the spam that we find aren't really bad actors bots. They're more reposting bots that don't really bring sentiment with them. So there's lots of automated posters or bots that will just rebroadcast news essentially. And that could be, stocks that just reported earnings. It could be stocks that just went above or below their 50-day moving average. It could be whatever very easy generic news or market related item it is to report. And of course, they're posting this information, I guess, to drive people to their website for whatever purpose. But generally speaking, there's no sentiment attached to that. It's just factual, it's just news, and the model can ignore it. And even if it doesn't ignore it, it would certainly label it as neutral, and it wouldn't have an impact on the overall buzz score or its inclusion in the index.
So I alluded to it at the beginning of our podcast, and so I'm going to have to ask you about GameStop. Really kind of woke up Wall Street and the rest of the world. I heard from people I hadn't talked to in a while, and they were just all chatting about GameStop and what have you. And not to get too much into the specifics and the technicals of what really happened, but did the GameStop example show the power of individual investors, of social media, or both?
I think both. I think, what GameStop really was a byproduct of something that's been happening in these online communities for years now, and things that we've been measuring in Buzz. And I think for a lot of those years, people didn't pay attention to it or wanted to dismiss it because, again, of the way that, the retail or the individual investor typically being perceived on Wall Street. And so what I think the whole Reddit and Wall Street Bets forum and what we saw with GameStop and some of these other stocks is that there really is an intelligent and thoughtful community of people out there. And we're talking about the individuals who highlighted a real arbitrage, I think, in their minds, right? It was a short squeeze arbitrage, and they could share and collaborate and explain it on this community. And that's just a reflection of how broad-based the conversation is being. I think what you find on Reddit, what you find on Wall Street Bets is typically the conversation is much more narrow. It's really not a platform for broad and diverse conversation about stocks like you would find on Twitter, or you would find on StockTwits or other potential forums. Really what happens on Reddit is narrow in its focus. It's much more one story at a time, as opposed to a real community looking for engagement. And that's just an offshoot of people talking about stocks online. There is, room for a community of people like that. But what it really demonstrated to the broader investment community was that these individuals surely can move markets. While a lot of people are now focused on what might next be said on Wall Street Bets or on Reddit, I think that's not the right question to be asking, because that was an event that was not a one time, but that won't be a persistent, where we're going to wake up every morning and there's going to be a new target out of Wall Street Bets that we all have to deal with. I don't think that'll be a new reality at all. But I think what the right question to be asking is, okay, now that's woken us up to the idea that there is a lot of people online talking about stocks and that their opinions matter. Where else are they talking and what else are they saying? And I think that the more traditional investors or traditional asset managers start to look at these platforms like StockTwits and recognize just how large that community is and just how many people are talking about those stocks, I think for the most part, people are shocked when they see that. Of course, we're not, because we've been watching it for a long time and a part of that community for a long time, but it really is an enormous ecosystem of individuals, and they're coming at the conversation from a much different perspective than what you see on Reddit.
So what's one long-term trend you're excited about or you see playing out over the next year or several years?
One thing that I has continually grown over the last 5 years at least, and I think will continue to grow, is naturally, more and more people going online and collaborating and talking about stocks. I think I mentioned earlier, when we started this project at Periscope, 2 million people, or we had 2 million posts a year that we were processing through the models. And, gosh, that felt like a lot of data back then. Today, we're up to 15 million. And what we've seen, especially going through the pandemic, as more and more people live their lives online, I don't think that behavior changes. I think what that really was is just an acceleration of a trend that was going to happen anyways. And so where we're doing 15 million plus posts a month, pre-COVID, that was half that. So we saw this big jump up in conversation, and it is being sustained even as many parts of the world begin to reopen. So people are staying on those platforms and have clearly found some value there. And I would expect that trend to continue. The other long-term trend I would expect to continue is SPAC issuance. My goodness. There seems to be no end in sight to that, but I do believe it's rooted in some fundamental truths, and that's why I think it will continue, in the sense that we're at a generationally low number of listed public companies and a generationally high number of private companies held in either private equity or private form. And so I think that vehicle has found itself to be the way to allow a lot of those private companies to begin a public life. So I think that's a trend to stay.
It's time for the trend or fad speed round. I'm going to throw out a few different topics. You can just let me know, trend or fad. Virtual conferences and events.
Trend, 100%.
You think it will still be doing that even after COVID?
Absolutely. I think that, again, fear of the unknown prevented a lot of things from happening, right? Including work from home realities or virtual events. I think there was a misconception around how productive we as a community, investment community at least, could be working from home. And now we've got a year's worth of history behind us to allow us to all feel comfortable about the idea that people working from home can in many ways be more productive than in an office environment. Hours of commuting saved. There's very little differentiation between home and work now. And so there's a lot of productivity gains from that. And to the extent that, we can have this conversation in this manner, as opposed to, me going to an airport, getting on a plane, taking the taxi in from LaGuardia, how many hours did we just save and can devote to more productive measures? So I think an absolute trend.
Micro influencers, trend or fad?
Oh, that's a definite trend. Absolutely. I think the way we absorb content and make decisions is forever changed with the internet. And to the extent that, all of these people are going and creating content, it's almost no different than what's happening with the individual investors and talking about stocks, right? People have more information, more ability to communicate that. They're better educated. They can share. They can reach more people. We don't need to be told anymore by advertisers what's a good product. We can figure that stuff out for ourselves. And we don't need to be told necessarily anymore what stock to buy in our portfolio. We can also figure that out for ourselves, and sometimes better than the advice we were getting. So I think that would be a for sure trend.
Thematic investing, trend or fad?
Trend, but I think, again, the idea of some of the thematic investing is that it's a very, very narrowly focused, right? And so that requires either the individual or the portfolio manager or the advisor to try and identify a market environment that we are in or going into in which themes might benefit from, right? And so to the extent that you can now get exposure to a portfolio of gaming stocks, by way of example, I think that makes a lot of sense, because if you want to make a bet that that theme is going to continue to play out into the future, you have an easy, efficient, accessible way to make that bet. Whether gaming stocks should be in your portfolio forever and at what weight is a different question, right? So it's just, like I said earlier, it's more arrows in the quiver, more tools for advisors to use. I think they're absolutely appropriate, and I think they make a lot of sense depending on someone's view of what theme they're trying to express.
Shareable e-scooters, trend or fad?
I hope fad, and the reason is because they don't come with helmets. And I remember not too long ago where almost everyone you would see on a bicycle or a scooter would be wearing a helmet, much like everyone wears helmets skiing today, and no one did 20 years ago. But now with all of the shareable scooters and shareable bikes, and every city has them, they don't come with helmets. And that just amazes me that the cities are encouraging that kind of behavior. So I'm going to hope fad. And I'll say if they start coming with helmets with, maybe a disposable liner to them, then we'll call it a trend.
Well, I guess we have to leave it there. Jamie, thank you so much for joining me on Trends with Benefits.
Thank you so much for having me. Really enjoyed the conversation.
And thank you for tuning in to another episode of Trends with Benefits.